Hi, this is your very own Dharmishta Shah, leading financial advisor. Based in Mumbai, services pan India. Are you one of them who really wants to understand how equities are taxed and how one can save income tax with planning of shares? As we are going into a momentum of closing down our tax planning for the year 2021, let's understand first the types of capital gains that are taxed in equities. There are short-term capital gains and long-term capital gains. If an investor is holding shares listed on the stock exchange, that's recognized stock exchanges, NSE and BSE, for more than 12 months, the gain or loss arising from the sale shall be considered as long-term capital gains. So, here the tax that is applicable is LTCG tax, right? Now, let's see the rates of the taxes on these gains. Short-term gains on the above shall be taxed at 15% under section 111A, and if the STT which is charged at 0.1% both at the time of buying as well as during the sale of the shares. Long-term gains on the above shall be taxed at 10% under section 112A, only on capital gains exceeding rupees 1 lakh and above. So if your long-term gains comes to, let's say, 3 lakhs, so the gains on the equities are less than the limit. So one need not pay tax and there is no other income hereby. Short-term gains can be adjusted against both short-term gains taxed at 15% as well as the long-term gains taxed at 10%. However, long-term loss can be adjusted only against the long-term gains taxed at 10%. So the very first tax saving tip here is to book short-term loss on the shares. To simplify, sell the short-term shares in loss before 31st March. By doing this, one is actually using that loss to set off against the short-term gains and hence save at 15%. One needs to follow the portfolio. There can be few stocks which you have bought during the financial year. If it makes loss, sell them, book losses, and at least on paper, once that is done, this will help you set off against both the short-term and long-term gains tax. Remember this, if you are convinced that a stock is a great buy, even though in loss, you can buy again after a couple of days. That's from 1st April 2021. For now, our important aspect is filing the income tax return in time. The due date for individual and HUF, that's in the non-audit case, is 31st July and for others, it's 31st October. Belated return filing would mean non-eligibility of carrying forward the short-term and long-term capital losses. The losses from the intraday trading are tagged as speculation loss, and this cannot be set off against the regular short-term or long-term sale of shares. That's it from me. This is your very own Dharmishta Shah. You can connect with us on 9322244095. Me being a financial advisor since more than 18 years now. Husband is a CA, practicing CA. So you have a one-stop solution for all your financial needs. Speed up and ensure that you plan your taxes right and investments too. Bye for now. Take care. Happy investing.